If I lost everything tomorrow and had to rebuild my fortune from scratch in 2026, I wouldn't waste time looking for the next hot stock or trying to find some undiscovered gem. I'd do something much simpler and much more certain. I'd buy 4 blue chip stocks and hold them for the rest of my life. Not 10 stocks, not 20 stocks, 4. These are businesses so dominant, so profitable, so well managed that I could buy them, put the certificates in a drawer, and not look at them for 30 years. When I opened that drawer 3 decades later, these businesses would be worth many times what I paid. They'd be throwing off enormous dividends, and they'd still be the leaders in their industries. I'm Warren Buffett. I'm 94 years old. I've been investing for over 80 years. I've built one of the largest fortunes in the world, and I'm going to tell you exactly which 4 blue chip stocks I would buy if I had to start over in 2026 with limited capital. These aren't speculative plays. These aren't growth stocks that might work out. These are the safest, highest quality businesses on earth. Companies that have survived world wars, depressions, recessions, technological disruptions, and every challenge you can imagine. And they're still here, still dominant, still profitable. Today, I'm going to tell you which 4 stocks these are, why I'd buy them, how to value them, and most importantly, why you should probably own them too. Before I reveal the 4 stocks, let me tell you what I mean by blue chip. This term comes from poker, where blue chips are the most valuable chips. In investing, blue chip stocks are the most valuable, most reliable companies. But what specifically makes a stock blue chip? First, size and dominance. Blue chips are large companies that dominate their industries. They're not small companies trying to make it. They're already there. They've won. They have massive market shares that are difficult to take away. Second, long operating history. Blue chips have been around for decades. They've proven their business models work through different economic environments. They're not new companies with unproven strategies. Third, strong financials. Blue chips have clean balance sheets, low debt relative to earnings, high returns on equity, strong free cash flow generation. They don't need external financing. They fund themselves. Fourth, consistent profitability. Blue chips make money every year, not just in good years, every year. Even in recessions, their business models are resilient enough to stay profitable through downturns. Fifth, dividend history. Most blue chips pay dividends, and they paid them for many years, often decades. The dividend gets maintained and increased through good times and bad. This shows financial strength and management commitment to shareholders. 6, competitive advantages or moats. Blue chips have something that protects them from competition, brand power, network effects, economies of scale, switching costs, regulatory barriers, something that makes it hard for competitors to take their business. 7th, quality management. Blue chips are run by competent, honest managers who allocate capital well and think long term. These 7 characteristics define blue chip stocks, and the 4 I'm going to tell you about have all 7. Now let me reveal the 4 stocks. Stock number 1 is Coca-Cola. I've owned Coca-Cola since 1988. Berkshire bought 5% of the company for $1 billion. Today, that stake is worth about $25 billion and generates over $700 million in annual dividends. This is one of the best investments I've ever made. And if I were starting over today, I'd buy Coca-Cola again without hesitation. Let me tell you why. First, Coca-Cola is the strongest consumer brand on earth. 2 billion servings per day. Think about that number. 2 billion servings every single day. People in over 200 countries drink Coca-Cola products. The brand is recognized by 94% of the world's population. This brand power has been built over 139 years through consistent quality and massive advertising investment. Nobody can replicate this. A competitor can't create a brand that matches Coca-Cola no matter how much money they spend. It would take decades and tens of billions of dollars. And even then, they'd be fighting uphill against people's emotional connections to Coke. This brand is an unassailable moat. Second, Coca-Cola's business model is beautiful. They don't manufacture most of their products. They create concentrate and syrup. That's it. They sell this concentrate to bottling partners around the world who add water, bottle it, distribute it, and sell it. This asset-light model means Coca-Cola doesn't need much capital. They don't need billions in manufacturing plants or distribution networks. The bottlers handle that. Coca-Cola just creates the concentrate, which has very high margins. Gross margins on concentrate are probably 70 to 80%. This is extraordinary. And because they don't need much capital, they generate massive free cash flow, about $10 billion per year. This cash flow funds dividends, buybacks, and growth investments. Third, Coca-Cola has adapted to changing consumer preferences. Yes, soda consumption is declining in developed markets due to health concerns. But Coca-Cola is no longer just a soda company. They own Dasani and Smartwater, Honest Tea, Simply Orange and Simply Lemonade, Minute Maid, Fairlife Milk, Costa Coffee, Powerade. They're a total beverage company with leading brands in nearly every category. When consumers shift from soda to water or juice or coffee, they shift to another Coca-Cola product. The company doesn't lose revenue, it just redirects customers to a different part of the portfolio. Fourth, Coca-Cola has enormous growth potential in developing markets. In the United States and Western Europe, per capita consumption is high. Everyone already drinks Coke products. Growth is modest. But in Africa, Southeast Asia, India, parts of Latin America, per capita consumption is much lower. As these markets develop and people enter the middle class, beverage consumption increases. Coca-Cola is positioned to capture this growth. They're already there. They have distribution, they have brand recognition. As incomes rise, people buy more Coca-Cola products. This gives the company a growth runway for decades. Fifth, the dividend is exceptional. Coca-Cola has paid dividends for over 100 years. They've increased the dividend for 62 consecutive years. This is dividend king status. The current yield is about 3%. The payout ratio is about 75% of earnings, which is sustainable given the high free cash flow margins. The dividend grows about 5 to 7% per year. If you buy today and hold for 20 years, your yield on cost will be over 9%. In 30 years, it'll be over 18%. This dividend compounding is how you build wealth. Sixth, valuation is reasonable. Coca-Cola trades at about 24 times earnings for a business this high quality with this track record. That's fair. Not cheap, but not expensive. You're paying a fair price for an exceptional business. And the 3% yield gives you immediate income while you wait for the stock to compound. Seventh, management is solid. CEO James Quincy has done well. He's expanded the portfolio beyond soda. He's invested in developing markets. He's maintained capital discipline. He's returned significant cash to shareholders through dividends and buybacks. I trust this management team to allocate capital wisely. If I were starting over with limited capital, I'd put 25% into Coca-Cola. At current prices, around $60 per share, I'd buy as many shares as I could afford. I'd reinvest every dividend to buy more shares. I'd hold for 30 years, minimum. The dividend would compound. The share price would grow. In 30 years, that position would be worth many times my initial investment and generating huge income. Coca-Cola is as close to a sure thing as exists in investing. The business model works. The brand is impregnable. The dividend grows every year. This is the foundation of a blue chip portfolio. Stock number 2 is Visa. Visa is different from Coca-Cola, but equally compelling. Visa runs the payment network that processes credit and debit card transactions. When you swipe a Visa card anywhere in the world, Visa gets a small fee, usually around 2% of the transaction value. This might not sound like much, but Visa processes trillions of dollars in transactions. Those small fees add up to enormous revenue. And because Visa doesn't lend money, they don't take credit risk. They just process payments. This makes the business model incredibly profitable and safe. Let me explain why Visa would be my second stock. First, Visa benefits from the secular shift from cash to digital payments. Globally, about 80% of transactions are still done in cash. As economies develop and digital payment infrastructure improves, this shifts to cards and digital wallets. Every transaction that shifts from cash to card generates revenue for Visa. This trend is unstoppable and will continue for decades. In countries like Sweden, cash is nearly extinct. In the United States, cash usage is declining steadily. In developing markets like India, the government is actively pushing digital payments. All of this benefits Visa. Second, Visa has a two-sided network effect. The more consumers have Visa cards, the more merchants accept Visa because they want access to those customers. The more merchants accept Visa, the more valuable Visa cards become to consumers because they can use them everywhere. This creates a reinforcing cycle that makes Visa more dominant over time. And it creates a massive barrier to entry. A new competitor would need to convince millions of merchants to accept their cards and millions of consumers to carry their cards. Nearly impossible when Visa is already everywhere. Third, Visa has massive operating leverage. Processing a payment costs Visa almost nothing. The infrastructure is already built. Adding more transactions doesn't require proportionally more costs. So as volume grows, incremental profit margins are very high. Visa's operating margins are over 60%. This is exceptional. Most businesses would be thrilled with 20% operating margins. Visa does triple that. And as volume continues growing, margins can expand even more. Fourth, Visa is asset light and generates enormous free cash flow. They don't need factories or inventory or expensive infrastructure. They have data centers and software. That's it. Capital expenditures are low. Free cash flow margins are probably 50%. They generate about $20 billion per year in free cash flow. This cash flow funds massive share buybacks and dividends. Over the past decade, Visa has bought back probably $100 billion in stock. This is why earnings per share have grown much faster than revenue. Fifth, Visa has pricing power. Every year, they raise fees slightly. Merchants complain but pay anyway because they can't afford not to accept Visa cards. Consumers don't care because they're not paying the fees directly. This pricing power lets Visa grow revenue even if transaction volume growth slows. And it protects margins if costs rise. Sixth, international growth is massive. About 50% of Visa's revenue comes from outside the United States. As developing markets adopt digital payments, international revenue will grow faster than domestic. This gives Visa years of double-digit revenue growth potential. Seventh, valuation is moderate. Visa trades at about 27 times earnings. For a business growing earnings at mid-teens rates with 60% margins and massive free cash flow, this is reasonable. Not cheap, but not expensive. You're paying a fair price for a compounder. If I were starting over, I'd put 25% of my capital into Visa. At current prices around $290 per share, I'd buy as many shares as I could. I'd hold for decades. Visa doesn't pay a huge dividend, only about 0.8% yield. But the stock price compounds as earnings grow. Over 20 years, I'd expect Visa to deliver 12 to 15% annual returns through a combination of earnings growth and modest multiple expansion. This would turn 25,000 into about 200,000 over 20 years. Visa is a compounder. Buy it and forget about it for decades. Stock number 3 is UnitedHealth Group. UnitedHealth is the largest health insurance company in America. They also own Optum, which provides healthcare services including pharmacy, benefit management, data analytics, and care delivery. The combination of insurance and services makes UnitedHealth uniquely powerful. Let me tell you why this would be my third stock. First, healthcare demand is non-cyclical and growing. People need healthcare regardless of the economy. In recessions, healthcare spending stays stable or grows. As the population ages, healthcare demand increases. The baby boomer generation is entering peak healthcare consumption years. This demographic wave will drive healthcare spending for the next 2 decades. UnitedHealth is positioned to capture this spending. Second, UnitedHealth has scale advantages. They cover over 50 million Americans. This scale gives them negotiating power with hospitals and doctors. They can demand lower prices because they deliver huge patient volumes. Smaller insurers can't match this leverage. Scale also allows them to spread fixed costs like technology and administration over a larger base, improving margins. Third, the Optum business is brilliant. Optum provides services to other insurers, employers, and providers. This diversifies revenue beyond just insurance. And Optum is growing faster and has higher margins than the insurance business. Over the past decade, Optum has gone from about 20% of UnitedHealth's revenue to over 40%. This mix shift improves overall profitability and reduces cyclicality. Fourth, UnitedHealth generates massive free cash flow, about $25 billion per year. This funds acquisitions to expand Optum, share buybacks, and dividends. The dividend currently yields about 1.3%. Not huge, but the dividend has grown at double-digit rates. Over time, the combination of dividend growth and stock price appreciation delivers attractive returns. Fifth, the business model has switching costs. Once an employer chooses UnitedHealth for employee health insurance, switching is difficult. Employees are used to the network of doctors. Changing insurers disrupts care. This stickiness creates stable, recurring revenue. Sixth, UnitedHealth has demonstrated excellent management.
CEO Andrew Whitty and his predecessor Stephen Hemsley built UnitedHealth from a regional insurer to the dominant national player. They've allocated capital well.
The Optum acquisition strategy has created enormous value. They've grown earnings per share at double-digit rates for over a decade. I trust this management team. Seventh, valuation is attractive. UnitedHealth trades at about 21 times earnings. For a business growing earnings at low double digits in a non-cyclical industry with strong competitive advantages, this is reasonable. You're not overpaying. If I were starting over, I'd put 20% into UnitedHealth. At current prices, around $500 per share. I'd buy what I could afford. I'd hold through the inevitable political controversies around healthcare costs and insurance. The business model works. The demographic trends are favorable. Over 20 years, I'd expect mid-teens annual returns as UnitedHealth compounds earnings and continues gaining market share.
Healthcare is one of the few sectors where I'm confident about long-term growth. UnitedHealth is the highest quality way to play this trend.
Stock number 4 is Costco. Costco is a warehouse retailer. They sell products in bulk at low prices to members who pay annual membership fees. This business model is simple but incredibly powerful. And Costco has executed it brilliantly for 4 decades. Let me tell you why Costco would be my 4th blue chip stock. First, the membership model creates recurring revenue and customer loyalty. 92% of members renew each year. This is extraordinary retention. Once you're a Costco member, you keep renewing because the value is so obvious. You save far more than the membership fee costs. And psychologically, once you've paid the fee, you want to shop there to get your money's worth. This creates a flywheel. Members shop more. Costco gets more data on what products members want. They optimize the product selection. Members find more value. They shop even more. The cycle reinforces. Second, Costco's pricing strategy builds customer trust. They limit markup to 14%. This is codified in the company culture. If they can sell something cheaper, they do, even if they could charge more and customers would pay. This honesty builds incredible loyalty. Customers know Costco isn't trying to maximize profit on each item. They're trying to give customers the best value. This trust is a moat. Third, Costco's scale allows lower costs than competitors. They buy in massive volumes. Suppliers give them the best prices because a Costco order might be 10 times larger than a competitor's order. These savings get passed to customers as lower prices. Competitors can't match Costco's prices without losing money. Fourth, the treasure hunt merchandising keeps customers engaged. Costco constantly rotates products. You never know what you'll find. High-end electronics, designer clothing, jewelry, furniture. This unpredictability makes shopping fun and drives frequent visits. You check regularly to see what's new. This increases purchase frequency and basket size. Fifth, Costco generates most profit from membership fees, not product sales. Last year, they collected about $4 billion in membership fees on revenue of over $200 billion. These fees are essentially pure profit. This lets Costco operate the merchandise business at break-even or small profit. They can undercut competitors on price because they don't need margin on products. The membership fees cover costs and generate profit. This is a brilliant business model. Sixth, Costco has tremendous growth potential. They have about 870 stores globally. Walmart has over 10,000. Target has nearly 2,000. Costco could double or triple store count over the next 20 years. Each new store generates about $200 million in annual revenue. This growth is predictable and profitable. Seventh, management is exceptional. Former CEO Jim Sinegal built a culture of value and integrity. Current CEO Ron Bachris is continuing that tradition. They've maintained the pricing philosophy. They've treated employees well, paying above industry wages and providing good benefits. This attracts and retains the best workers. Employee tenure is high. This shows in customer service quality. Eighth, valuation is full but justified. Costco trades at about 45 times earnings. This is expensive for a retailer, but Costco isn't a typical retailer. The membership model, pricing power, and growth potential justify a premium. And if you're holding for 20 years, paying 45 times earnings for a business that will grow earnings at 10% annually, still works out well. Your cost basis becomes more reasonable as earnings grow. If I were starting over, I'd put 30% into Costco. This is my largest allocation of the four because I have the highest confidence in Costco's business model and growth trajectory. At current prices, around $900 per share, I'd buy what I could afford. I'd hold for decades. Costco doesn't pay a large dividend, only about 0.6% yield. But they occasionally pay special dividends and the stock compounds as the business grows. Over 20 years, I'd expect high single-digit to low double-digit annual returns as Costco opens stores, grows same-store sales, and increases membership fees. Costco is one of the best-run retailers in the world. It deserves to be a core holding. Now let me explain the allocation. Coca-Cola, 25%. Visa, 25%. UnitedHealth, 20%. Costco, 30%. This is a concentrated portfolio. Only 4 stocks, but these 4 give you diversification across consumer staples, financial services, healthcare, and retail. You have domestic and international exposure. You have businesses that thrive in different environments. Coca-Cola and UnitedHealth are defensive. They do fine in recessions. Visa and Costco are more cyclical but still resilient. Together, this portfolio will compound steadily through any environment. Let me show you the math. Assume you have $100,000 to invest today. Coca-Cola, $25,000. Visa, $25,000. UnitedHealth, $20,000. Costco, $30,000. Let's project 20 years with reasonable assumptions. Coca-Cola grows at 6% annually. Visa grows at 12%. UnitedHealth grows at 11%. Costco grows at 9%. These are conservative estimates based on historical performance and future potential. After 20 years, your Coca-Cola position is worth $80,000. Your Visa position is worth $240,000. Your UnitedHealth position is worth $160,000. Your Costco position is worth $168,000. Total portfolio value is $648,000. You started with $100,000. You have 6.5 times your money in 20 years. That's a 9.8% compound annual return. And this assumes you never added another dollar. If you invested $5,000 per year, in addition to the initial $100,000, keeping the same allocation, your 20-year portfolio would be worth $1.3 million. This is how you build wealth with blue chip stocks, not through trading or market timing, through owning quality businesses and letting them compound. Now let me address common objections to this 4-stock strategy. Objection 1, this is too concentrated. What if one stock fails? These are blue chip companies. The risk of failure is very low. Coca-Cola has been around for 139 years. Visa for decades. UnitedHealth for decades. Costco for 40 plus years. They've survived everything, and they're diversified across industries. The chances of all 4 failing or even one failing are minimal. I'd much rather own 4 excellent businesses I understand completely than 20 businesses I barely know. Objection 2, you're missing growth stocks. What about technology? What about AI? I'm not trying to maximize short-term returns. I'm trying to build wealth reliably over decades. Growth stocks are volatile. Many fail. The few that succeed make up for the failures, but you have to pick the winners. With blue chips, I don't have to pick winners. They've already won. I'm just buying their continued dominance. This is safer and works just fine over long periods. Objection 3, These stocks are expensive. Should I wait for a crash to buy them? No. Don't try to time the market. These companies are high quality. They trade at premiums because everyone knows they're good. Waiting for a crash means you might wait years and miss dividends and growth, and if a crash comes, you might be too scared to buy. Better to buy quality at fair prices now and hold for decades. Timing the market beats timing the market. Objection 4. What about international stocks? Shouldn't I own some European or Asian companies? These 4 companies all have massive international operations. Coca-Cola generates 60% of revenue outside the U.S. Visa is global. UnitedHealth is primarily U.S. But healthcare is domestic everywhere. Costco is expanding internationally. I get international exposure through these U.S. domiciled companies without the added complexity and risk of foreign stocks. Objection 5. This portfolio doesn't pay much in dividends. The yield is low. The weighted average yield is about 1.6%, not high. But I'm focused on total return, not just current income. Visa and Costco have low yields but high growth. Their stock prices compound. Coca-Cola and UnitedHealth have moderate yields with good growth. Over time, the total return from all 4 will be excellent, even if current income is modest. And as dividends grow, your yield on cost increases dramatically. Objection 6. What about inflation? Will these stocks protect me? Yes. All 4 have pricing power. Coca-Cola can raise prices. Visa raises fees. UnitedHealth raises premiums. Costco raises membership fees. When costs rise due to inflation, these companies pass it on to customers. Their earnings grow with or faster than inflation. This protects purchasing power better than bonds or cash. Now let me tell you how to actually implement this portfolio. Step 1, decide how much to invest. Add up all investable capital, retirement accounts, taxable brokerage accounts, savings beyond emergency fund. Let's say it's $50,000. Step 2, open a brokerage account if you don't have one. Vanguard, Fidelity, or Schwab all work. Transfer the $50,000. Step 3, buy the 4 stocks. Coca-Cola, 12,500, about 208 shares. Visa, 12,500, about 43 shares. UnitedHealth, 10,000, about 20 shares. Costco, 15,000, about 17 shares. Place the orders. They'll execute immediately. Step 4, set up automatic investing. Decide how much you can add monthly. Let's say $1,000. Set up automatic transfers from your bank. Set up automatic purchases, maintaining the 25, 20-30 allocation. Every month, 250 goes to Coke, 250 to Visa, 200 to UnitedHealth, 300 to Costco. This happens automatically. You don't have to think about it. Step 5, set up dividend reinvestment for the stocks that pay dividends. Coca-Cola and UnitedHealth pay quarterly dividends. Have those automatically reinvested to buy more shares. This compounds your holdings. Step 6, rebalance annually. Once a year, check your allocation. If one stock has grown to be much larger than target, sell some and buy the others. This forces you to sell what's done well and buy what's done poorly. Mechanical value investing. Step 7, hold for decades. Don't sell when the market crashes. Don't sell when one stock disappoints for a quarter. Don't sell when some analyst downgrades a stock. Just hold. Let the businesses work. Let the dividends compound. Let time pass. Step 8, add money consistently. Every raise you get, increase your monthly investment. Every bonus, invest it. The more you invest, the faster you build wealth. These 4 stocks can absorb unlimited capital. They're highly liquid. You can invest millions if you have it. Step 9, ignore the noise. Don't watch CNBC. Don't read market predictions. Don't obsess over daily prices. Check your portfolio quarterly or annually. That's enough. Spending time researching and worrying doesn't improve returns. It just creates anxiety. Step 10, teach others. Share this strategy. Help family and friends build wealth. The more people investing intelligently, the better. Now let me walk you through specific scenarios. Scenario 1, you're 30 years old with $20,000 to invest. Put $5,000 in Coca-Cola, $5,000 in Visa, $4,000 in UnitedHealth, $6,000 in Costco. Invest $500 per month split proportionally. Hold for 35 years until age 65. Assume the portfolio grows at 9% annually with monthly contributions. At age 65, you'll have about $2.3 million. You invested $230,000 over 35 years. You turned it into $2.3 million. This is the power of starting young, investing consistently, and holding quality stocks. Scenario 2, you're 50 years old with $100,000 to invest. Put $25,000 in each stock, except Costco, which gets $30,000. You don't have 35 years. You have 15 years until retirement at 65. Invest $2,000 per month. At 9% annual returns, you'll have about $1.2 million at 65. You invested $460,000, turned it into $1.2 million. Not as dramatic as the 30-year-old because you have less time, but still excellent. You can retire comfortably on $1.2 million generating dividends and living off partial sales. Scenario 3, you're 65 and retired with $500,000. You can't afford much risk. Should you still use this portfolio? Yes, but shift the allocation to be more conservative. Increase Coca-Cola and UnitedHealth, which are more defensive. Decrease Visa and Costco, which are more cyclical. Maybe go 30% Coke, 20% Visa, 30% UnitedHealth, 20% Costco. This gives you more dividend income and stability. You can live off the dividends plus selling small amounts of the growth stocks as needed. Now let me address taxes. Where should you hold these stocks? Prioritize tax-advantaged accounts. Max out Roth IRAs first. The 4 stocks will grow tax-free forever in a Roth. No taxes on dividends, no taxes on capital gains when you sell, no taxes on withdrawals in retirement. This is ideal. If you've maxed Roth IRAs, use traditional IRAs or 401k plans. These give tax-deferred growth. You pay taxes when you withdraw in retirement, hopefully at lower rates. If you've maxed all retirement accounts, use taxable brokerage accounts. In taxable accounts, these stocks are reasonably tax efficient. Coca-Cola and UnitedHealth pay qualified dividends taxed at capital gains rates lower than ordinary income. Visa and Costco pay small dividends and grow mostly through price appreciation. You only pay capital gains tax when you sell, which you can defer for decades. Hold these stocks long term. Don't trade. This minimizes taxes and maximizes compounding. Let me now tell you why these 4 stocks specifically beat alternatives. Why not own Apple? Apple is excellent. We own a lot of it at Berkshire. But if I'm building a 4-stock portfolio from scratch, I want more diversification. Apple is technology. These 4 stocks give me consumer staples, financial services, healthcare, and retail. More balanced. Why not own Microsoft? Same reason. Great company, but I want sector diversity. Why not own JP Morgan or Bank of America? Banks are more cyclical and leveraged than I want in a concentrated portfolio. Visa gives me financial services exposure with better economics. Why not own Amazon? Amazon is expensive and doesn't pay a dividend. Costco gives me e-commerce exposure through their online business plus the membership model I love. Why not own ExxonMobil or Chevron? Energy is too cyclical and dependent on commodity prices. I want businesses with more stable cash flows. Why not own Procter & Gamble or Johnson & Johnson? Both are excellent. I'd happily own them. But Coca-Cola fills the consumer staples slot. UnitedHealth fills the healthcare slot. I can only pick 4. These 4 give me the optimal combination of quality, growth, yield, and diversification. Now, let me tell you what makes this portfolio resilient. First, these businesses have survived everything history has thrown at them. Coca-Cola made it through 2 world wars, the Great Depression, stagflation, multiple recessions. Visa made it through the 2008 financial crisis when credit markets froze. UnitedHealth thrived through healthcare reforms and regulatory changes. Costco grew through the dot-com crash and the Great Recession. These aren't fragile businesses. They're anti-fragile. They get stronger through adversity. Second, they have pricing power. In inflation, they raise prices. In deflation, they maintain margins. In good times, they grow. In bad times, they stay profitable. This flexibility is rare and valuable. Third, they generate cash. Free cash flow funds dividends, buybacks, debt reduction, growth investments. They don't depend on external financing. They're self-sustaining. Fourth, they're run by competent, honest managers. I trust these leadership teams to make good decisions. I don't have to worry about fraud or empire building or stupid acquisitions. They'll do the right things for shareholders. Fifth, they're loved by customers. People want to drink Coke. They want to use Visa cards. They want health insurance from UnitedHealth. They want to shop at Costco. This customer loyalty is a moat that's hard to break. Let me close with this. If I had to start over in 2026 with limited capital, these 4 stocks, Coca-Cola, Visa, UnitedHealth, and Costco, would be my entire equity portfolio. I'd buy them in the allocation I described. I'd invest consistently. I'd reinvest dividends. I'd hold for decades. I wouldn't trade. I wouldn't try to time the market. I wouldn't chase hot stocks. I just own these 4 blue chips and let them compound. In 20 years, this portfolio would be worth many times what I paid. In 30 years, it would be a fortune. This isn't speculation. This is investing. Buying great businesses at fair prices and holding them while they grow. It's simple. It's boring. And it works. These 4 blue chip stocks are all you need to build substantial wealth. Start today. Buy what you can afford. Hold for decades. Your future self will thank you.